December jobs report surprised to the upside, and unemployment actually dropped, which was a little bit of a surprise for some Wall Street economists. But now all the talk is, will we have interest rate cuts this year? Because when the Fed meets, and right now Wall Street is thinking March is when we're going to see that first rate cut, is today's jobs report going to delay that? And if so, what's that mean for the markets? Welcome, everyone, to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I am joined by my friend and co-host, Tobin Smith, out in sunny and chilly Scottsdale, Arizona. I got to tell you, Toby, I don't see it, but whatever. Anyhow.
52 degrees is 22 for you, okay?
There you go. There you go. Well, our guest today actually is thinking, because she did a lot of analysis on a potential interest rate cut, or actually looking at the broader rate structure and wondering what that means for real estate. Nicole Middendorf is joining us today, CEO from Prosperwell Financial out of Minnetonka, Minnesota. I know it's cold there, Nicole. I mean, because I'm cold here in Buffalo. I'm sure you're feeling it there as well, but thanks for joining the program.
Yeah, thanks for having me. I've got the turtleneck on. It's 33 degrees, but no snow.
There you go. Okay, well, maybe that'll come
Isn't
later
this,
on.
though, a new do a little bit, Nicole?
Does it what?
The new do, a little new hair program?
No, same old, same old, same old.
Okay.
I'm going a little darker because it's winter. It's gloomy.
There you go. There you go. Just like the drinks. You got to have the dark drinks right now until Memorial Day. So,
Yeah.
But Nicole, I do want to start with you because we have clearly today's jobs report that came out, surprised to the upside. Participation rate actually did drop, which explains the drop in unemployment. But you have an interesting analysis because all the talk is wondering if we're going to have interest rate cuts. But you seem to think that interest rates are just going to go down on their own. But you also are looking further into this. Can you explain to the audience what you explained to us earlier?
Yeah, so it's specifically like the real estate market. We have a problem. We have people that can't afford to live in homes. And so how is that all going to fix? And for that to get fixed, one of three things needs to happen is income for people needs to go up over 60%. It's 68%. Well, that's
What?
that's not possible. Like that's not going to happen. The second thing that would need to happen is the real estate market would need to go down and correct over 30%. It was 32%.
There you go.
That I don't know that it's going to go down 30 some percent. But the third thing is rates need to come down to 4.5. Well, none of
mortgage
those
rates.
things.
Mortgage rates have to come down.
Mortgage rates need to come down to 4.5. And you have to look at this from a perspective. Like people are panicking in my eyes. Like they're like, oh my God, rates are so high. Rates are so high. Like if you look historically, rates on average, mortgage rates are 6%. So, if right now you're getting a mortgage at 7.99, like it really isn't from a long-term perspective, like that's not the end of the world. We just got so used to rates of under 3 and 3%. And so if you look at like one of those three things happening, I don't know. I don't see incomes really going up. I do see the real estate market correcting, and I see rates coming down, not mortgage rates coming down to 4.5, but rates are, yes, going to come down. I don't know if it's going to be this first round, but at some point this year, I mean, they're going to have to. And we're already seeing it with like CD rates and things like that. So.
Yeah, Todd, I will say that it feels like the people, first off, the 6 rate cuts, I don't know what they're smoking, but they have much better drugs than I do out here. For a variety of reasons, starting just with the idea that same person who says there's going to be 6 rate cuts says we're going to have a 5,200, S&P. Well, right. Dude, the reason why we'd have 6 rate cuts is if we have a freaking depression or a massive, shutdown in the economy. And they would do that the way they did that, in front of the pandemic, et cetera. So you can't have both of this, in my opinion. You can't expect. Now, what you can expect is that the core inflation, to Nicole's point, that's holding everything up is rents, leases, mortgage, shelter costs. And shelter costs are 54% of the core now. They have to come down. And so that's the intrigue here. If interest rates come down, mortgage rates come down, that makes places more affordable, which puts a bid into the market for housing. And at the same time, if rates are coming down, then interest sensitive sectors will do better, and in sectors particularly that are on variable rate loans, et cetera, so they will come down. But the people sitting with the 40% of people who own their homes for cash don't care. The people, the 32% on top of that finance their houses with less than a 2% freaking mortgage, they're not moving. Yeah. So we still have the same intractable problem, is that the only new homes that are being built are built in areas like here out in North Scottsdale and other places where people are coming in from California with cash and buying them for cash, or you're out in Bufu nowhere, and yeah, you got a great house, but it takes you 70 minutes, to go to the shopping center. It's not a simple formula, but that's why people are moving to Oklahoma, Tulsa. Look, do you see some of the numbers now?
And
Nicole?
even out of the country, people are moving to less expensive locations to be able to afford it. Because, you go to the grocery store and you're buying a little thing of freshly cut pineapple and it costs you $12. It's astronomical.
Well, Nicole, you're living high end, okay? Those of us in the middle class, we actually buy the pineapple and we cut it ourselves.
I do that sometimes, but the other day I did not have time to cut the pineapple.
Okay, all right.
And pineapple is the best.
That was a bad shot.
Pineapple is the best to boost your metabolism. So
okay, that's good. That's good to know.
Totally
I gotta say, when we saw the number come out today, the markets clearly sold off because there was that uncertainty, wondering, okay, how could the Fed possibly start cutting rates, because the economy seems to be so healthy right now. And I think that's where the really where the conundrum is for Wall Street right now, and that's why we haven't started off so well in equities. We clearly missed the Santa Claus rally, but now as we move forward this year, and you're right, Toby, talking about 6 rate cuts. That means they got to get started in March, and I don't see it happening because the economy continues to be at least strong or healthy moving forward, at least through the
Todd, there were 2 things in this appointment part if you go deeply into it. One was that the number of immigrants who took new jobs was almost at a historic rate. And I got some feedback from subscribers and some clients saying, River, the damn immigrants are taking all our jobs. Really? Come on, man.
Yeah.
The boomers.
No one else will work. No one else will work.
No one doesn't want to work. The 40% of own the homes free and clear, they're not working. Many of the boomers, we got 10,000 turning 65 every day till 2031. You got 5,000 turning 70. They're not going to take the freaking sweat and hustle job. And, I don't know if you remember this history of people out there, but, this is an immigrant country. I'm from Northern Ireland. The Scottish and the Irish got together and came over here in 1789.
You can tell this is a Friday show.
Yeah. Come on, man. We don't have enough babies. We have 37% of kids between 21 and 30 living at home.
Right.
I
get it.
Why would you expect anything else?
So, Nicole, for your investors, I'm sure they're like most people. We've been hearing about this $5 trillion that's sitting in money market funds. I was asking Dr. Ed the other day on the show on Buy, Hold, Sell. We were wondering what are your clients doing? Are they still in cash? They missed the rally in the fourth quarter, or are they starting to get back into equities?
People are starting to get back in, but people overall are holding more cash, particularly in their non-retirement accounts. I still am seeing tons of people that have, like, we just had another new client that called today, 200 grand in her checking account.
Right.
Wow.
And we went through this pandemic and people are like, oh my God. And then the talk of inflation out there, just that scares people. And so a lot of people are kind of hoarding money. Now, having said that, I'm also seeing, like, you look at the statistics that show savings rates are going down and credit card debt is going up. And so that is not a good thing. But overall, people are very cautiously optimistic about where we are and investing their money. I mean, that's where, we're still doing lots of structured CDs. We're still doing buffered ETFs,
Oh,
investing
wow.
money with some protection around it, because the average person is a little scared and nervous. The other thing too, we're also seeing is a lot of people are having sudden layoffs that they were not prepared for.
Expecting,
And
yeah.
there's this talk that more and more of that may be coming.
Yeah, right sizing after the craze. I will say this. I had a client come in and a new client named Delio. And this is like, $3-4 million, right? She's got $1 million in, because she was so smart, she bought those 5%, 6-month CDs, et cetera.
Mm-hmm.
But I said, honey, you live in California. Do you understand you didn't earn 5%? Your income level and your investment income, after you pay tax in California, and then after you pay the federal tax, and then you pay the tax because you didn't take any money out of these accounts, so now you owe more taxes. You're probably going to make 2%, whereas if you were, with us being very tactical all during the year, you'd be up 40% and it would be in your IRA or it'd be in your Roth, and you wouldn't do that. And she looked at me, about to cry. Said, "Who was your advisor? I mean, he was telling you you're just getting rich on 5%. Wait till you see that tax bill, girlfriend." So
right, well, definitely
there's going to be a lot of that happening, don't you think, Nicole? That people are going to say, "OMG, I totally forgot about that."
Right. And also, I mean, you talked about the number of people turning 65. There's a lot of those people that are business owners, and they're passing their business on in the next generations. And that, particularly here in Minnesota, we're so high taxed that's a huge issue. So we're seeing a lot of like gifting of the stock of the business into that next generation. Lots of succession planning talk.
Wow.
I'm sure of that. Well, listen, we're going to leave it there on this block, because coming up next, we have to ask Nicole if she's going to start changing her allocation for her clients based off of the jobs number and potential of interest rates dropping. But with us today, Nicole Middendorf. She is the CEO of Prosperwell Financial out of Minnetonka, Minnesota. And we will be right back after the break. Please stay with us.
Buy, hold, sell, brought to you by Crosscheck Management.
Like the Kentucky Derby, Woodford Reserve Bourbon is a spectacle for the senses.
You make me sparkle, you make me tingle, even the stars are brighter when I'm with you. And when I surrender to a tasty kiss or two,
Martini and Rossi Asti.
Make me sparkle, yes.
Make the moment sparkle.
With the December jobs report surprised on the upside, and we actually saw our first up day of the year on Wall Street. It must be because of our guest, because she obviously brought the good luck for not just this show, but also for all the traders out there. But with us today is Nicole Middendorf. She is the CEO of Prosperwell Financial out of Minnetonka, Minnesota. You can go to prosperwell.com to see all of Nicole's offerings and what she has to say there. But Nicole, when we left off on the last block, we were talking about the potential of rates dropping and what that could possibly mean for real estate. You're an avid reader. You read all the time. You're just like Toby. Toby, I think, is an actual professional reader.
I am a professional reader.
Knowledge. Absolutely. Just the knowledge is just coming in. You actually read something, though, that as optimistic as everyone is right now, this actually drew some concern for you. Can you explain to the audience what the article was about?
Yeah, I mean, everything I see this year is like, this year's going to be good. It's, great. Like, everyone's very optimistic, but it was this whole booklet, and it really looked at like the next 10 years. And I had to stop it took me a couple of nights to read it because I had to stop reading it because I was getting so depressed. It was like doom and gloom, because I'm looking at where am I in my career, and I'm getting closer to retirement. I'm like, seriously, like I'm in the prime. Like this is supposed to be like the best next 10 years for me. I'm like, seriously, like single digit returns, things aren't going to be great. Everything from population to politics to you name it. It was very doom and gloom for the next.
What were they selling though, Nicole?
What were they selling?
Yeah.
Mutual funds, investments.
Oh, okay. Yeah, but it's a mutual fund that is set up to prosper.
Yeah, that's short.
Yeah.
Exactly.
Yeah. Remember, financial publisher here, editor for 25 years. I'll put together a report, research report, etc., and then you give it to the copywriters, and they would take like one sentence out of the thing and try to get a headline. And then they either, we only have one emotion in investing, it's fear. It's either fear of loss or fear of FOMO, missing out. So if you're trying to get headlines, just take that one first paragraph and scare the crap out of people, or say that if you don't do this now, you're going to miss out on this bonanza and you're going to be poorer than that poor schlub, your brother-in-law you can't stand. It's copywriting. And I think people should actually have to read a 2-page disclaimer that says if you're going to be subscribing to financial publications, remember that they're going to try to scare the crap out of you, or they're kind of trying to hit your greed button, and you need to be able to pull back like my camera shot is right here.
Cameraman's been at happy hour. For those that are listening, you definitely want to watch the video.
Yeah.
So Nicole, so you're reading this, it makes you depressed, brings you down, but overall, you still seem to be optimistic. What's your take what are you telling your clients for 2024? Is now a good time to be in equities, or should everybody stay on the sidelines?
Well, we are finding that a lot of people have a lot of cash, and with anything, it's never best to just like, if you have 200 grand sitting in your checking account, it doesn't mean like go tomorrow or Monday and put all that money into the market. It's looking at, okay, where did I end up for last year? Where am I? And where are there some opportunities, or what am I short in? Because I'm really finding a lot of people don't pay enough attention to their money, in my opinion. And you most of the time, especially if you have a couple, you have a husband and wife, and they're adding to their retirement plans, their 401ks, their IRAs, they're busy with their kids, they've got their 529 plans. And it's like, you need to really take an assessment of where you are. And it surprises me, but it doesn't. The amount of people that when I meet them, I'm like, oh my gosh, like, are you like this couple the other day? I'm like, are you kidding me? You've been adding the wife had not been adding to her retirement plan at her work. They're super high income. So they're just hurting themselves tax wise, but then they had over 50% of their money invested internationally. And so many times it's pay attention, just all of a sudden, okay, if I have all this cash, it doesn't mean throw it in. It's really take a good assessment of where are you short, where are you missing, and what pieces could make the most sense for you for your puzzle.
Did you say pieces or pieces? I couldn't tell.
Pieces for your puzzle.
So, my favorite one was someone also recently came in and their Asian background, and they were buying the dip in China. The dip in 2021, the dip in 2022, the dip in 23. And I was like, do you ever look at this stuff? I mean, or what's your premise? That all of a sudden China's going to change, or this depolarization is going to change, or the fact that they don't have enough children, or all that stuff. And it's almost like they get a meme in their head. Man, you're going to make a lot of money in China, and they just keep doing it. And they probably lost 400 grand just by being 25% in China, because God damn it, I'm going to be right one of these days, right? You ever get those, like the stubborn? I know it's going to be happening. Okay, great. I'd advise you go to someone who will take care of your psychological problems, because that's not what I do. Okay, so.
That's funny. So Nicole, what about the presidential election? Jeffrey Hirsch has said, and regardless of who you're favoring or whatever, that's not the point. But Jeff actually brought up a good point from the Stock Traders Almanac that for the incumbent, as long as they run, the S&P historically has gone up 8%. If
Yep.
they don't run, then you see the S&P drop 1.5%. I know a lot of people are still scratching their heads wondering if Biden's still running, but do you get a lot of clients that are asking you about this? Because one thing that we've noticed with the guests coming on Buy, Hold, Sell is that this is a recurring theme. They do bring up the election cycle, and how that can impact equities. But what do you think?
Yep. I feel like every 4 years, my world is like, oh, everything's great because it's an election year. But that really is the truth. I don't want to say like, you have all these statistics of like who was running, who got elected, and I feel like people put too much weight on the presidential election. I feel like, what can one person actually change? But it's that leader that like drives us to where we are and, helps and makes changes from taxes, policies, you name it. But I feel like people put too much emphasis on election and historical results. But yes, historically, an election year is always a good thing for the market.
Yeah, I mean, it's a better year when the president and the Congress are on the same team, because then they spend a lot more. And so if you take Jeffrey's almanac numbers, who've been just dead right on everything, and then you go to the way when they both, the same party's in charge, those are really good years. So it because the stuff, all the money that's going to certain areas, the graft, money going to other projects. So it does historically, but also somewhat of a self-fulfilling prophecy. Now, take the other side of it, which is, as goes January, so goes the year. I think first off, they're disregarding the fact that we had a 9-week run which is historically very rare. And people who pay taxes were saying, I'm not really going to take that $500,000 profit I have in NVIDIA that went up for me. I think we're up 270% in NVIDIA. And I've said, let's do something else, unless you have some, other stuff you can go against that. But whatever you do, don't sell it on December 30th, you bonehead. And but this is Todd, I'm just saying this is a natural course of a melt up. And then the short-term investors who were momentum and the algorithms were running the money for them. Instead, we just keep piling on. We move our sell stops. And that's one segment of the market. Nicole's segment of the market, a whole different crew. Nobody's day trading, I assume, in your organization.
No.
Or the algorithms aren't, buying momentum. My favorite one is when yesterday, 84% of all trades on the NASDAQ and New York Stock Exchange were algorithmic.
Wow.
Because the algorithm said, if you've been above the 20-day moving average for 6 weeks in a row and it drops, you sell, and particularly if it's a new year, right? So it's hard to explain to people that there is a market of stocks, and there's the 80% plus that trade not based on the fundamentals, not based on the company, not based on their macroeconomic. It's just rule-based.
Yeah.
And some of the biggest hedge funds in the world are just rule-based. And if they decide on Tuesday to sell NVIDIA, it's going to be down 10%. Who cares?
Right.
You also have people that are selling for their life. Like they're taking their RMDs in the beginning of the year. They're selling because they had gains, or they're selling in their non-retirement accounts to add to their Roth IRAs. I mean, there's so many different, we're having lots of clients that are selling for, lots of people are like, I've had it and I'm taking my kids on this trip, or I'm doing these things.
Right.
And
That's
there's, lots of paying off debt. I mean, lots of liquidations these first couple of days this year.
Interesting. Well, but that makes sense though. There's a reason to do it.
It's historic. It like happens every January. As much money as we have coming in of people adding to their IRAs and they're starting their contributions for that year, we also have tons of people that are pulling money out for the RMDs and just living their life.
What are the RMDs? I'm sorry.
required minimum distributions.
I'm sorry. Okay, I was hearing
So-
B, not D. Okay.
You're not
Oh,
at that
yeah.
age yet, Toby.
I thought you were talking about the Chinese renminbi.
You're not that old yet.
Yeah, you got a few years. Yeah.
Holy mackerel!
It's
Yeah,
all
right.
those
So-
old people
something to
having
look
take
forward
money
to.
out.
Yeah, exactly. Well, listen,
That's
I'm the biggest proponent of the Roth, and I'll do the math for people if they have some losses, and we can roll some of these into a Roth, and then these weekly dividend ETFs. I know you're familiar. Just roll. The freaking compound return is stupid ridiculous.
Yeah.
And we had Yield Max on, we've had Defiance on, and they really turned me on to this for a Roth. It's just ridiculous. The compounded return on, let's say, their top 5 ETFs. We just got we had for $100 million. We got $3.8 million in dividends just from $100 million. So do that math, right?
Right.
And then we reinvest it. And because the day the dividend goes, or the day the dividend exit dividend, the price comes down, etc. So then when they pay, we reinvest, but the underlying stocks we own anyway as well. It's pretty hard to beat, man. I mean, it's pretty hard to beat.
You got that right. So, Nicole, before we close out the show, I have to ask you, favorite sectors for 2024. What are you telling your clients?
Technology, healthcare. Like that's where you just look at, even though people are getting older, I mean, the amount of people we have a client who's in her 80s who's having her total shoulder replaced on Monday. So healthcare and tech. And at the same standpoint, like consumer staples, like taking that from a standpoint of like, okay, like people are not going to be spending money like they were before, in my opinion. So playing those dividend stocks.
Okay.
But within healthcare, because healthcare sucked last year, as you know, pharmaceutical, biotech, GLP-1. For instance, we're long Amgen. We've been long, Novo for a while. But Amgen also has a very exciting GLP-1 weight loss drug that's about 30 days away from, I think, 30 to 60 to be approved. And it sells at much lower than its normal price earnings ratio. They're going to sell direct, just the way Lilly just started this week. Dude,
Yeah.
I told Todd, I made a beef Wellington for 10 people for New Year's. I got the foie gras in there. I got the duxelles in there, etc. Turned out that 6 of the people are on freaking vitamin O, Ozempic, and they only ate half of what they normally would eat. So I'm still like, I've got the refrigerator full of freaking beef Wellington. You can only eat that so many days, Todd. I'm just telling you right now.
I'll be over there on Monday for the championship game. So
Okay.
there you go. So we're going to leave it there on the show, guys. So we want to thank you, Nicole, for joining us today. You said it all. We want to invite the audience to go to prosperwell.com to see what Nicole has to say there and of her offerings there as well.
And send her an email when it's -20 in the next 4 days. Okay?
Yes, absolutely.
Funny.
But Nicole, thank you so much for joining us today.
You're very
Buy,
welcome.
Hold, Sell. We
Thank
can't
you.
wait to have you back. So on
thank
behalf of Nicole Middendorf and Tobin Smith, I am Todd Schoenberger.
Nicole Middendorf.
Thank you once again for joining us on Buy, Hold, Sell. Have a great weekend. We'll see you next week. We have Sam Stovall, Jeffrey Hirsch, Gina Martin Adams for joining the show. Can't wait to have you back again as well. Take care.
Buy, Hold, Sell, brought to you by Crosscheck Management.
If you like Buy, Hold, Sell Live, be sure to smash the like button.